Welcome to this explainer. Look, if you've checked your portfolio recently, you've probably got whiplash. Right now, we're jumping straight into a high-stakes tug of war that is literally tearing through the global stock market. It's July 22nd, 2026, and honestly, things are incredibly tense. On one side, you have this roaring technological rebound trying to lift everything up, but on the other, the heavy, unforgiving gravity of global geopolitics dragging everything right back down. It's a fascinating dynamic, and we're going to break down exactly what's happening, why it's happening, and where the smart money is actually moving. We're witnessing a brilliant tech rebound right now, just flashing green across the boards. But here is the billion-dollar question lingering in the background. Are we seeing a genuine recovery, or are investors walking blindfolded into a highly dangerous bull trap? I mean, we just saw a brutal sell-off driven by intense fears over AI valuations, and now suddenly the money is rushing right back in. But is that foundation actually solid?
Well, there is a massive psychological disconnect happening right now. The fear and greed index is pointing directly to fear at a level of 41. So despite the cash flowing rapidly back into tech stocks, there's this underlying terror keeping investors awake at night. People are absolutely buying the dip, yes, but they are doing it with their finger hovering directly over the panic button.
Part 1, Wall Street leads the tech rebound.
After that harsh AI-driven sell-off we just talked about, Wall Street is aggressively trying to shake off the dust and lead the global charge upward once again. Capital is rapidly flowing back into semiconductor and big tech stocks. The broader market landscape is shifting, as investors rush to buy the dip in these highly specific tech sectors, really hoping they found the ultimate bottom. The S&P 500 has bounced back impressively from its critical 7,440 support level. It's hovering right around 7,490 points now, approaching short-term resistance. But the crucial point here is that it's not just tech carrying the weight anymore. We're actually seeing capital rotate into cyclical sectors as well, broadening out the base of this bounce. And that is a much healthier sign for your everyday portfolio than tech carrying the entire weight alone.
But make no mistake, the undisputed star of the last 24 hours is the Nasdaq 100. It absolutely smashed into the 29,200 point mark. Intense FOMO, that fear of missing out, is just taking over. Investors are acting like kids waiting for Christmas morning ahead of highly anticipated earnings reports from heavyweights like Alphabet and Tesla. This semiconductor surge is single-handedly pushing the Nasdaq right into breakout territory. Meanwhile, far away from the tech frenzy, the Dow Jones Industrial Average maintains this remarkable, quiet stability, reaching 52,400 points. What we're seeing here is a strategic rotation. Money is moving into cheaper, traditional, large-cap companies. It's really a search for value in a market that just got deeply spooked by astronomical growth valuations. This steady upward climb of 0.74% for the Dow shows us that this sector rotation is providing a rock-solid foundation. Even with the wild swings in tech, this movement into traditional large caps acts as a vital safety net for the broader U.S. market. Moving on to part 2, Asia and Europe's synchronized recovery. So this surging Wall Street optimism is triggering a synchronized recovery globally. Over in Japan, the reaction was explosive. The Nikkei 225 shot upward by over 4.5% straight from its 62,800 support level. And if you look under the hood, this was driven almost entirely by a sea of green in Japanese tech stocks, perfectly mirroring the semiconductor enthusiasm we just saw on the Nasdaq. However, when we zoom out to the broader Asian board, the picture gets far more complicated. Japan's massive rally actually hit a brick wall right around the 67,600 mark early in the session. Why? Well, they're being dragged down by heavy macroeconomic burdens. A significantly weak yen combined with the high cost of expensive imported oil is putting a severe cap on how high Japanese markets can fly right now. Over in Europe, it's a similar story of tech-led optimism. The STOXX Europe 50 is flashing green, largely because European tech stocks jumped more than 2%. For the moment, this tech enthusiasm is allowing European markets to simply brush aside their own intense local fears about energy inflation. But, as we're about to see, ignoring surging energy costs is a dangerous game of financial chicken. Part 3, the climax, two opposing forces. The global market is currently trapped in a massive high-stakes tug of war. On one side, you have the upward push. Investors are holding their breath for big tech earnings. The market needs absolute proof that the billions of dollars poured into AI are actually generating real revenue. On the opposing side, you have the downward drag, complex Middle Eastern geopolitics, and surging oil costs. These two monumental factors are actively fighting for control of the market's trajectory, and investors are essentially stuck right in the middle of this seesaw. Crude oil is aggressively pushing toward $87 a barrel. This is that downward drag we just talked about, happening in real time. Ongoing geopolitical risks involving the US, Iran, and Houthi rebels in the Middle East and Red Sea are pushing Brent crude higher. And here's why this matters to you. If oil spikes, the ghost of inflation returns. That could force central banks like the Fed and ECB to hold interest rates higher for longer. And as we know, high interest rates are the stock market's ultimate enemy. Which brings us to part 4, forecast and strategy. So how do we actually navigate this collision? The short-term forecast currently sits at a stark 60% probability for a negative outcome. Here's the scenario. If tech giants like Alphabet and Tesla this week, and Microsoft and Apple next week, fail to absolutely crush their earnings expectations and deliver incredibly bright future projections, the market will view this as a shakeout. We'll likely see a rapid drop, making it very difficult for the S&P 500 and Nasdaq to test historic highs and easily breaking right through current support levels. Because the market is essentially rolling the dice right now, the data strongly points to a defensive strategy. It's fascinating how quickly sentiment shifts, isn't it? Maintain a neutral stance, and whatever you do not short tech right before earnings. That is just way too risky. Instead, urgently shield your portfolio. Hedge with safe haven assets like the US dollar and gold, or rotate into defensive sectors like energy and consumer staples. Ultimately, as you look at your own portfolios this week, you have to ask yourself one definitive question. Can the promise of an AI utopia truly outpace the heavy, unforgiving gravity of global conflict and surging oil? The earnings reports dropping this week will give us our first real answer.
Thanks for joining me for this explainer, and stay sharp out there.